Welcome to the first video on concepts in finance. Today we will look at how we can compare different cash flows using the so-called present value. Let's start with a simple timeline of 1 year. We are currently at T0. Imagine someone offers you two alternatives of cash flows. The first option is to get $1,000 now at T0. Second option is to receive $1,100 1 year from now at T1. Which one would you choose? If you get the $1,000 now, you could invest it for 1 year. And let's assume you put it in a bank and get a return of 5% per year for sure without any risk. That would mean after 1 year, you would have $1,050. How did we calculate that? Take the $1,000 and multiply it by 1 plus the risk-free interest rate of 5%. This is called the future value of the cash flow because it's the value of our $1,000 today in the future after it has earned interest. Now we can compare the two cash flows valued at the same point in time, which is in year T1. Clearly 1,100 is more than 1,050 in year 1 and thus option 2 is more beneficial. Another way to think about this decision problem is by discounting the cash flow in year 2 using a discount rate, which is in this case 5%. Before, we grew the money by the yield to get the future value. Now let's go back in time and discount the 1,100 by the discount rate to get to the present value. To do that, we calculate $1,100 and divide it by 1 plus the interest or discount rate. This is called the present value because it's the value of our future 1,100 in the present. And now we can compare the two cash flow streams in the present at T0. Again, we see that 1,048 is more than 1,000 and thus again option 2 is more beneficial. So both methods give us the same answer. It's only crucial to compare the value of cash flows at the same point in time. By using either the future value or the present value, we can make informed decisions about which cash flow option is better. We can also apply these concepts for longer periods of time. Let's look at a timeline of 5 years, and we are again at T0. Now the two alternatives are getting $1,000 today or $1,300 in 5 years. Assuming that we again put the money in a bank with a risk-free return of 5%, we can apply the same concept of future value and compound our investment over 5 years, earning a yield of 5% each year. Remember that in year 2 and every subsequent year, we also get interest on the interest we accrued over the previous years. This is known as compound interest. After 5 years, our initial $1,000 will grow to approximately $1,276. How do we calculate that? We multiply our initial $1,000 by 1 plus the interest rate for the first year times 1 plus the interest rate for the second year and so on for each of the 5 years. That means we can also calculate 1,000 times 1.05 to the power of 5. So the general formula for the future value of cash flows can be stated as cash flow times 1 plus the annual interest rate to the power of the number of years. Using this formula, we can compare the two streams of cash flows in year 5 and see that option 2 is more beneficial since 1,300 is more than the future value of our $1,000 today, which is 1,276. Again, we can also look at the same decision problem by going back in time and discounting the $1,300 to its present value. To do that, we calculate the present value of $1,300 received in year 5 by dividing 1,300 by 1 plus the interest rate to the power of 5. Doing that, we get the present value of approximately $1,019. This is the value of our future $1,300 in the present. Again, we can derive the general formula for the present value as cash flows divided by 1 plus the annual interest rate to the power of the number of years. By using this formula, we see that 1090 is more beneficial than 1000, and thus option 2 is more beneficial. Therefore, both methods, compounding to get the future value or discounting to get the present value, give us the same answer. It's only important that we compare the value of cash flows at the same point in time. Thanks for watching. Stay tuned for more videos on finance concepts, and if you found this helpful, please like and subscribe, and see you next time.